Hey there, folks. This is Mitch Firestone. A few days ago, during a live session with you guys, we had covered a setup and the subsequent entry in a trade involving CVS drugs. And so I wanted to kind of do a little follow-up on that because what we talked about, if you recall, was a bit of trade management technique. And so I kind of wanted to show you sort of a progress report of kind of how it's progressing and, kind of do a really quick review also of what was discussed because, it was a little involved. And so all of this bears a little further repetition and then again, do a progress report. So let me go into this again. So at any rate, here is the daily chart of CVS. And so this was something I had looked at on January 13th. Which now is about a little over, coming up on 3 weeks ago. At the time, this is a daily chart. And so essentially we had kind of a rally base and a rally here. Notice this string of green, bullish candles, each one of which had a little gap down and then kind of progressing upwards. And you could see, obviously, this was more or less a steady march up. After a couple of bullish candles, and then kind of a rocket at the very end there, and that kind of matched, that kind of ended that big move there. Okay, and so we had a drop. So I'm almost thinking of this as a drop, a base, and a rally here, and I kind of really like that. Even within a rally base rally, if I can see a clear sign of a reversal within the rally base rally, that often kind of gives me a little extra faith because ultimately, of course, when price returns to this level. If it's retracing down, if it's pulling back, what are we looking for? We're looking for a reversal, of course. So if we can see prior evidence of a reversal, even within what's referred to as a continuation pattern, that's often a good sign here. And I even threw in here the fact that we see a reversal here. So at any rate, that was the setup. And so we were essentially waiting for a pullback. This level was actually created back in, you can see in October, on basically October 18th of 2021. Okay, so you can see, of course, in showing the detail here, we could not actually see the big picture of where we are today. So what I did was obviously I created the setup and marked it all up in considerable detail, but then I compressed everything here so that we could then see the big picture. Okay, so there's that same exact level, except of course all compressed and without all the annotations. So here was the level from October of 21, and then of course we were at the time when I created this on the 13th of January, we were waiting for the pullback into this level. So of course price was sitting a touch under $3 above that level there, above the demand zone. So at any rate, that's the underlying concept behind the setup. So at any rate, we ultimately, this thing got posted on the 13th of January, and we subsequently got entry, okay, which was on the 25th, okay. So we ended up buying the call, and we got in at 660. If we go back here for a second, we can see that we bought the the May 19th. Call expiring obviously this year at the 82.50, which was of course below the range of the demand zone there, and we're probably running a delta of probably somewhere in the 55 to 60 or even low 60 area because of the fact that when we got in, we were approximately a little less than $3 in the money. From 85.30 down to 82.50, so that's about $2.80 in the money. So that would I'm not bringing up the options platform, but that would seem to suggest we were probably running a delta of at least 55, 57. It could have been as high as 60 or 62. All right. So at any rate, that was the setup. Okay. So we ended up getting a pullback into this, and we got a pop, and then one of our subscribers asked, well, what do we do with this? I don't want to watch this thing become, obviously, this thing is awesome. It's working nicely now. So what do I do to sort of manage it so that, I'd like it to go as far as possible, but on the same token, if for some reason, let's just say there's a big market downturn just because, the Federal Reserve says something, or there's some kind of geopolitical event, I don't necessarily, I kind of want to also maybe either lock in profit or sort of prevent it from becoming a loser if in fact, there's a pullback. So what do I do? And so we talked about in the last live session, or maybe it was even I guess it was the last live session, we talked about dropping the time frame down in order to manage it. So we got into the trade on a daily chart. And so what I suggested was we drop the time frame down to an hourly chart and then kind of manage it via the hourly chart. And then we could see what happens. And at that point, we could also lock in some profit. We can kind of look at a shorter term trend. And then as long as price kind of holds to some sort of shorter term trend, we could stay in the trade. And if it violates that trend, then we get out with, anywhere from let's say a decent or moderate profit to maybe, a substantial profit, if it kind of goes further. But this way we actually have a concrete metric to kind of stay in, as opposed to just kind of guesswork and gambling. Okay. So what I did was, we talked about this last time, was again, dropping it down to a 1 hour chart, the 65 minute for my preference. And I basically threw on the chart the 21 period exponential moving average and the 8 period exponential moving average. And all that means essentially is that, this is taking the 21, is taking the last 21 hourly candles and essentially determining, kind of what the average price is at any one moment. Now, it's not quite the average price of the simple moving average, because an exponential moving average actually gives greater weight to the most recent candles as opposed to the ones at the very beginning. Running under the assumption, of course, that recent history is more, has a greater validity and more valid than ancient history, or, ancient history in the context of, 21 trading hours, which of course is more or less 3.5 days. So this is the 21 period exponential moving average, again, giving greater weight to the most recent of those 21 candles. And so that creates that curve. Then we have the 8 period, and of course that's a much faster moving average, because this is only taking into account the last 8 hourly candles, which is essentially just, a little bit more than 1 day of trading, right? So 1 1/3 days of trading, to be precise. And so we can see this is where these two curves occurred beneath the price move. And so we talked about the last session about using a trend line, which essentially, and you can't really see it in great detail here, but this essentially has 3 points of contact on the lower side of these candles here. And so the one way some people like to manage their trades is via a trend line. As long as price doesn't close below the trend line, you're good. I'm not a fan of that. I find oftentimes that the trend lines are too restrictive when price is kind of hugging them. And so part of the point of having a trade metric to stay in the trade is, to some degree, you want to stay in the trade. So effectively what you need to do is give the trade a little breathing room. So you can't, if you're using a trend line like this, you're really only almost a breath away from getting stopped out of this, if in fact you're using this trend line. Now, once you, let's say, get a pop, and you may find yourself with a trend line here and then price sitting here, well, now you have some breathing room in here. But particularly when you're at the beginning of a trade starting to work, using a trend line, I find just utterly, really restrictive and really suboptimal. And again, a lot of traders may have a different opinion. That's my opinion. All right. So at any rate, again, here was our entry. Price gapped down into the zone, went across, consolidated in the zone for about 2 or 3 hours, and then we kind of started up. Okay. So again, now we're sitting just above this trend line in this screenshot here, and we were, and of course it's sitting above these moving average curves. Okay. All right. So now let's go to the live chart here, and let's just see what has transpired since. And this is kind of like your update and progress report here. Okay. So here's exactly what you were just looking at before. And actually, let me just also just bring this down. So you can see right here, this blue line here, this is your 1-to-1. This is a 1-to-1 move on the trade. That next one up there, which is circled there, is 2-to-1, 200%. And then, of course, right there is 3-to-1. And, of course, all that's based on, of course, the depth of this zone from entry down to the stop. So you can see there's your zone, but then we go down to the stop, and that's about, the stop is about almost 20 cents below. Okay, so here was your entry here. And actually, I'm sorry, 84.12. Sorry, I was looking at the wrong number here. So this is 84.12 down to 83.85. So in fact, this is a what is that? 27. What do we give this? 27 cents. Okay, so that's how much breathing room we gave that below the zone. Okay, so price started up here, and you can see price went up, and I think this is more or less where that prior screenshot got taken. Right there. So if you notice now in the next subsequent candles, in fact, this took you through Thursday when we did the session. Here's what occurred on Friday. In fact, what I'm going to do is I'm going to circle this. So this is what occurred on Friday within this blue circle. Okay. And I'm also going to blow this up just a little bit here. There we go. Okay. So what transpired on Friday? Price opened on Friday, and again, these 6 candles represent the trading action on Friday. So price opened here. Notice it immediately spiked down. Okay, it actually pierced the 8-period moving average, but then immediately rebounded. And if you recall, we always talk about we want to see the way we judge these things is we look for a close below the moving average. Okay, so simply having it spike down like that and then immediately bounce back, we're not setting this thing to automatically take us out after that spike down. And as you can see, of course, then it kind of then immediately rebounded. Then the next candle, down candle there, little consolidation. Again, we had a little spike down. Again, a little tiny pierce of the moving average, and then a pop. And then more or less this thing kind of goes sideways. It obviously went up, almost got to 2-to-1 and then pulled back. But that's where we are now. This is a perfect example though. And again, this could work out like gangbusters. It may not work out, or it may just kind of pull us, stop us out. But right now we've essentially locked us in. We're locked into this trade where we've locked in anywhere from 1.25-1 to 1.5-1, depending on which moving average you decide to listen to. This one again gives it a little more breathing room than this one. But notice that we've given this thing enough room to breathe, and we're still in the trade. And again, here's where your moving averages here. And so if we look here at current price, you can see it closed at 87.76. The moving average is at 48. So if you're looking at the 8-period, you have about 28 cents of breathing room here, from 76 down to 48. On the other hand, if you're giving it more breathing room by listening to the 21, then obviously you have, 68 cents of breathing room. So you have basically 40 cents more using this one rather than that one. If you basically take out this, if you use this one, then you're going to you've locked in, like I said, more or less, kind of a 1-to-1 trade by the time this thing rolls over a little. And then, like I said on this one, you're going to have, more or less, a little less than probably 1.5-to-1 if you kind of do this, listen to this. On the other hand, tomorrow, if it starts to, if it starts to head up, well, then this moving average is going to move up, that moving average is going to move up, but you'll now have a greater cushion. And so essentially this is, again, the, the whole concept of trade management. Here, let me get that stray number out of the way there. So that's your whole concept of trade management using the those two moving averages. And again, I wanted us to kind of highlight kind of how they behave once you have them in place, and also kind of compare and contrast them with the with the trend line there. And again, like I said, I'm not a fan of the trend line when it comes to the beginning of a trade, for the reasons that I said earlier. So at any rate, that's what I got. So we'll keep an eye on CVS as the week opens tomorrow, and there you have it. Anyway, this is Mitch Firestone. Thank you for the privilege of your time, and I will see you. Take care.